Welcome back. We are doing the second, see if I can get you going here. We are doing the second part of internal control in this chapter entitled Fraud, Internal Control, and Cash. So there are 8 elements of internal control, and we're going to walk through each of these. And the way these elements work is when we look at a situation in this chapter, we look for any risk that these elements are not happening, any violations of these 8 elements. So let's walk through them. So, establishment of responsibility. This control is most effective when only one person is responsible for a given task. Classic example is the cash register or passwords to track transactions. So if I'm signed on to my computer, I leave my computer, I sign out. If somebody else wants to use my computer, they sign in with their own sign-on and password, and all those transactions are captured. Cash register. When somebody is working the cash register, they are responsible for making sure that they collected the proper amount of money or checks or credit card receipts. If 3 people are working the cash register and money is missing, then you don't know which one of them was working when that error or fraud occurred. So you want to establish responsibility for the task. Segregation of duties sounds similar to establishment of responsibilities, but it is completely different. And segregation of duties is where you take 2 jobs and you have 2 different people working each job because they are what is known as related duties. So for example, one person keeps track of the physical cash and another person keeps track of the record keeping and balances it. Since those are 2 different people, the risk of fraud is lower. So record keeping of assets should be separated from physical custody of assets. Now there are other examples of segregation of duties. For example, the person who is purchasing the inventory is different from the person who pays the bill for the inventory. 2 separate people. When the same person does that job, there is more risk of fraud. Hire competent personnel, human resource controls. So human resources are the people that work for a corporation. How do you have these controls? You bond employees. Now what does that mean? All that means is that you take an insurance policy out on your employees so that if an employee who works with cash, for example, steals from the company, the insurance company covers the theft. So the company doesn't have to absorb the theft. Another way to have good human resource controls is to rotate employee duties and require vacations. This is a classic one where somebody never takes a vacation and she or he does all the bookkeeping or accounting for a company. It's important for that person to take a vacation and to have another person sit at that desk and do that job. In that way, you can catch any internal control irregularities and possible fraud. And finally, hire competent people, but conduct background checks. Call up each and every reference, call up the company and ask for general information. Often this step is overlooked when employees are hired. And it's so simple. Documentation procedures. Control numbers on all transactions. Any transaction that happens, any journal entry, any invoice, any purchase order, any of those things should be numbered and accounted for. If money moves around, there should be a way to trace each document back to a transaction and the person who approved it. And there should be approvals granted, either in the form of actual signatures or electronic signatures. Companies use checks. Account for all your checks. If a check is missing, all somebody has to do is write the check and the company will have to pay the bill. Of course, if it's fraud, there are opportunities to sue the person who committed fraud and to recover that money. Develop plans and budgets. And this is an area where a lot of individuals and companies are weak on. Establish an annual plan by department. Use it for evaluating people's performance and also use it for tracking costs. You said you were going to spend $90,000 this year. Looks like you're spending $150,000. What's going on? Tell us what happened. There may be a very good reason, but it's a good way to allow for some prevention and detection control. And of course, what did you actually do compared to the budget? Maintain adequate records. So this is the accounting department's job. Inspect and inventory plant assets. If you say you have 14 forklifts, go out and count them every now and then and make sure they're all still there. If you have a warehouse full of inventory, that needs to be counted at least once a year. So taking a physical inventory every year, we talked about that in Chapter 6. Adjust the books to match the physical inventory. Another asset is accounts receivable. So accounts receivable is money that is owed to us. When the company reports $150,000 in accounts receivable, an auditor should be able to come in, call up a sample of that $150,000 and determine that yes, those were actual sales and not pretend sales. Accounts payable confirmation, are all the debts reported? Are they truly owed? And we do that as well. And that's just a way to test whether what the company says it has is actually true. Physical electronic controls. If the company has cash, petty cash, put it in a safe, put it in a vault, lock the vault, don't leave it hanging open, lock your warehouses, have passwords, passcodes on your computers, have TV monitors at doors. For employees who are paid hourly, have time clocks or a way to clock in, alarms to prevent from theft, key cards, ID cards, etc. Independent internal verification. So what is this? Companies are required to have an audit, and this is done by outside auditors, but companies also have internal auditors. And of course, these are permanent employees who go around and audit the company over the year, over a series of years, and their job is to determine whether there are adequate internal controls in place and whether they're actually working. We have the internal controls, but we don't follow them. And then to report any areas for improvement. It is amazing how many times, if somebody knows their work is going to be checked, they'll do a little better job and they'll make sure they do the job correctly. This ends this section on internal control, part 2.